Welcome to the deep dive. Today, we are strapping in for, well, a pretty high-speed journey into the world of digital finance.
That's putting it mildly.
Yeah, forget everything you thought you knew about crypto regulation moving slowly, because we're seeing this sudden and massive acceleration of altcoin exchange-traded funds ETFs across North America,
Hmm.
and it's all driven by a huge shift in U.S. regulatory policy.
It's truly dizzying. I mean, just a few years back, getting a simple Bitcoin ETF approved in the US felt like climbing Everest.
Right, an impossible battle.
Exactly. And now we're already past Bitcoin, past Ethereum, and the focus is just sharply shifted. We're looking at a clear path for assets like Solana, XRP, Cardano, and a whole pipeline of others.
So the game has changed.
Totally. It's no longer if these are coming, but just how fast.
Okay, so this deep dive is basically your essential shortcut. We're going to walk you through not just what these new products are, but maybe more importantly, how the regulatory and financial gears are turning at, well, breakneck speed.
Yeah, and we've got the sources detailing the timelines, the, pretty complex ETF structures being proposed by big names like Fidelity and VanEck.
And the competition, right, the competitive landscape playing out as the U.S. sort of scrambles to catch up with Canada.
Mm-hmm. And our mission today, we want to use the Feynman technique,
Okay.
which basically means we're going to try and break down all this market and regulatory jargon, the 19b4 filings, proof of history, intermarket surveillance groups, all that stuff,
Into simple terms.
into clear, simple concepts for you, the learner. Because, the idea is if we can explain it simply, then we understand it deeply.
Love that. Okay, let's nail down the foundation first then. What exactly is a spot crypto ETF?
Right.
What's the simplest explanation we can give?
Okay, think of it like this. It's like buying a perfectly packaged, secure shopping basket.
Okay, a shopping basket.
Yeah, and that basket holds the actual crypto asset, let's say Solana, inside it.
But you, the investor, you don't really worry about the crypto itself.
No, exactly. You trade the basket itself on a traditional stock exchange, like the TSX up in Canada or the NYSE here.
So no messing with digital wallets, seed phrases.
None of that. You skip the complex digital wallets. You don't need to find a decentralized exchange. You hold a share in a regulated vehicle.
And that vehicle has to hold the actual crypto.
Yes, it's required to hold the physical asset, the actual coins, in secure custody.
Yeah.
Usually cold storage.
Okay, that's a really critical distinction because the structure is fundamentally different from, say, just buying Solana directly on an exchange, right?
Totally different. Holding directly means you take on the technical risks, the self-custody risks.
And it's also different from a futures ETF.
Right. A futures ETF tracks future price predictions. That introduces something called basis risk, where the ETF price might not perfectly track the spot price.
But a spot ETF.
A spot ETF gives you direct price exposure to the underlying asset, professionally managed, packaged for traditional markets. Simple as that. Or, well, simpler.
Simpler, yeah. So to help visualize this, you mentioned an analogy.
Yeah, let's try our first one. Think of buying a spot crypto ETF, not as buying a digital coin itself, but more like buying a certificate of deposit, a CD, for gold.
Okay, like a gold certificate.
Exactly. You hold that certificate in your brokerage account. It's easy to trade. But deep in a vault somewhere, the actual physical gold bullion is stored safely under really strict rules.
So the ETF is that certificate, but for the digital asset.
Precisely. It represents ownership of the underlying crypto held securely elsewhere.
Okay, let's unpack this. This regulatory earthquake you mentioned, the single biggest thing that changed the speed of all this happened September 17th, 2025. The U.S. SEC approved new generic listing standards, and this wasn't just a small tweak.
No, not at all. This was the tectonic shift. It basically opened the floodgates for commodity-based ETPs, including crypto.
So to really get the impact, we need to look at the old way.
Absolutely. Historically, every single spot ETF proposal for any commodity had to go through this really grueling manual review process.
The 19b4 filing.
That's the one. A full 19b4 rule filing. And this review process, depending on how many extensions the SEC decided to take,
Which they often did.
which they often did, yeah, it could stretch out to the maximum regulatory window of 240 days.
240 days, that's like 8, almost 9 months.
9 months, yeah, to
Right.
get yes or no. And that kind of timeline is just, it's painfully slow for an asset class that moves in minutes, not months.
And the reason the SEC accelerated this, it wasn't just out of the blue, right? Our sources say
Yeah.
it was really down to legal pressure.
That's a big part of it, yes.
Yeah.
Specifically following the grayscale victory in the courts. That ruling essentially forced the SEC's hand. It mandated that they treat spot crypto products similarly to crypto futures products if the underlying market met certain criteria about surveillance and manipulation resistance.
So defending that 240-day manual review for every single application just wasn't going to fly anymore legally.
Exactly. It wasn't tenable. So enter the new generic standards. These provide that much-needed express lane. Now, exchanges like NASDAQ, NYSE, ARCA, CBOE, they have pre-approved criteria.
Right.
They can use these to list qualifying, commodity-based, exchange-traded products, or ETPs. If an altcoin ETP meets these new generic standards, the paperwork's perfect, the asset is deemed compliant, the approval window just collapses.
From 240 days down to...
Potentially just 60 to 75 days.
Wow. That is a massive efficiency improvement. Let's use that second analogy you mentioned.
Okay, yeah. Imagine the old 240-day route was like waiting in line at the DMV, the Department of Motor Vehicles.
Oh, everyone loves that analogy.
Right. Every piece of paper had to be manually checked by, an overworked agent. Didn't matter how standard your application was. And heaven forbid you missed a single signature.
Back to the end of the 9-month line you go.
Exactly. But the new 75-day route, that's the pre-approved application window. It's like using a global entry kiosk at the airport.
Ah, much better.
If you meet all the preset criteria, you've got your passport, you've been voted, you basically walk straight through. The friction is minimized. The process is predictable.
So 9 months of uncertainty versus maybe 2 months of administrative review. Huge difference.
Huge. But this express lane isn't just open to anyone, right? It's not a free-for-all.
No, definitely not. To qualify under these new generic standards, the underlying altcoin, the crypto itself, has to meet specific, measurable criteria.
And it all comes down to the SEC's core concern, market manipulation.
Always.
So the coin has to satisfy one of two key surveillance criteria. First, it has to trade on an exchange that regulators can monitor through the Intermarket Surveillance Group, or ISG.
Okay, hang on. ISG, that sounds very official, maybe a little intimidating. Let's define that for people. What does the ISG actually do? How does sharing data stop fraud?
Good question. Think of the ISG as kind of like a global neighborhood watch, but for regulated trading venues.
Okay.
It's a group, a consortium of major exchanges, think NYSE, NASDAQ, CBOE, plus various big commodity exchanges. They all agree to share trading data with each other.
And this sharing lets regulators.
It lets them cross-check market movements. So if someone tries to manipulate the price of, say, a stock or a commodity on exchange A, the ISG surveillance system can often spot corresponding unusual trading activity happening on a related exchange B or C. It helps prove coordinated manipulation across markets.
Got it. So criterion 1, trade where the ISG police can watch. What's criterion 2?
Criterion 2 is the alternative, really important for digital assets. The altcoin needs to have a regulated futures contract listed on a major regulated market. The CME is the big one here, for at least 6 months.
6 months minimum.
Yes, and crucially, that futures market must have a proper data sharing agreement with the exchange that wants to list the spot ETF.
And that's the path Bitcoin and Ether took originally.
Exactly. They relied on the surveillance of the highly regulated CME futures market to basically vouch for the spot market's integrity.
Okay, and the impact of this rule change was immediate.
Instant and dramatic. On the very day the SEC announced the new generic listing process, boom, they approved the first U.S. ETF containing multiple crypto assets.
That was Grayscale's fund.
Yeah, Grayscale's digital large cap fund. It got instantly renamed the Grayscale CoinDesk Crypto 5 ETF. It holds a basket, Bitcoin, Ether, XRP, Solana, and Cardano.
All in one.
All in one. And approving a multi-asset fund instantly like that just shows the power and efficiency of these new generic standards. The institutional path is officially paved now.
Yeah.
Now, what's really fascinating here is, okay, the U.S. shift is huge. It's necessary.
Right.
But they're absolutely playing catch-up.
To Canada.
To Canada, yeah. Canada has been an innovation hub for crypto ETFs for a while now. Their regulators just took a different, maybe more pragmatic approach much earlier.
They really got a head start. Canada launched spot Bitcoin and Ether ETFs way back in 2021.
Years before the U.S.
Years. But the real signal, the one that probably woke everyone up, came in Q2 of 2025 around April. That's when Canadian firms launched North America's first spot Solana and spot XRP ETFs.
And we have the data showing this isn't just some niche experiment. It's a mature market with real institutional money flowing in.
Yeah, give us some examples.
Okay, the Canadian Solana ETFs, like the Purpose Solana ETF and the 3iQ Solana Staking ETF, they quickly attracted significant assets. The 3iQ fund alone hit, $353 million AUM.
Wow, for Solana. And the bigger picture, Bitcoin and Ether ETFs in Canada.
Huge. Total AUM is around $5.5 billion for Bitcoin and $746 million for Ether, Canadian dollars, obviously.
Those are serious numbers for the Canadian market.
Absolutely.
Yeah.
And analysts are projecting that the Solana ETFs, given how fast they started, could eventually settle around $250 million in AUM. That shows real confidence in altcoin adoption north of the border.
Okay, so Canada sets the stage. But this precedent is crucial because it highlights something that changes the whole game economically.
Yeah.
And creates friction with the U.S. approach.
Yes. The crucial feature, staking yield.
Okay, let's simplify this again because it's key to the next hurdle. You said it's like a high-yield savings account.
Yeah, let's elaborate a bit. Staking is fundamental to proof-of-stake networks, or POS networks, which both Solana and Ethereum use.
Instead of mining like Bitcoin.
Right. Instead of energy-guzzling mining rigs doing proof of work, iOS relies on participants locking up or staking their own coins.
Why? What does locking up coins do?
It helps validate transactions and secure the network. By having skin in the game, stakers are incentivized to act honestly. And in return for providing this service, the network rewards the stakers with newly minted coins, often called yield or staking rewards.
Okay, wait a minute. This completely changes the economics, doesn't it? Because many of these Canadian ETFs for Ether and now Solana, they actually do the staking.
Yes, they engage in staking activities with the crypto they hold.
And pass those rewards back to the ETF holders.
That's right.
So you're telling me the staking rewards, the yield, can be high enough to potentially cover the ETF's own management fee.
Yes, exactly. That's the potentially disruptive part. The Purpose Solana ETF, for example, actively stakes its holdings. It has a 0.39% management fee.
Which is already pretty low.
Pretty low, but depending on network activity and the staking yield, that yield could actually exceed the management fee.
Creating a zero fee or even positive yield ETF?
Potentially, yes. For the end investor. That's a massive competitive advantage over an ETF that doesn't stake.
Okay, so the Canadian model proves the demand, proves the structure works, but also flags the SEC's big problem area, the yield from staking.
Bingo. This brings us right to a key friction point, what we're calling the U.S. staking knowledge gap.
Because in the U.S.,
staking is a huge regulatory question mark. The SEC has been very aggressive in questioning whether staked Ether, specifically, should be classified as a security under the Howey test.
Because staking involves an expectation of profit from the efforts of others, potentially.
That's the argument. And this uncertainty has already led to a clear decision for the U.S. Ether ETFs.
They can't stake.
They are currently prohibited from staking their holdings, even though, as we just discussed, staking provides a clear, higher return for the investor. They're leaving yield on the table because of regulatory uncertainty.
Which leads us to our first major knowledge gap question for you, the listener. Given this undeniable, significant yield benefit shown in Canada, how will the SEC ultimately rule on staking mechanics for U.S. altcoin ETFs like Solana? And what specific regulatory disclosures will they demand to manage this risk for investors?
Right. The sources show the SEC is really drilling down on disclosures around custody, staking, fraud, and misconduct risk.
So if U.S. Solana ETFs can't stake?
They're immediately at a disadvantage, less competitive on returns compared to their Canadian counterparts.
Yeah.
That could easily lead to capital flowing north to capture that yield. It's a big decision point for the SEC.
Okay, let's dive deeper into Solana then. It seems to be the focal point right now for the U.S. altcoin ETF race. Why is it different, and what are firms like Fidelity actually proposing?
Right, Solana is definitely front and center. We need to simplify its core tech a bit. It's a decentralized network like others, but it uses a combination of proof of stake, POS, which we just covered, and this novel mechanism called proof of history, POH.
Proof of history. Okay, what does that do?
POH is the key to Solana's speed. Think of it like a super fast cryptographic clock, or maybe like a universally accepted, uneditable timestamp system for every transaction.
Okay, like a global receipt book.
Sort of. In older blockchains like Bitcoin, validators have to agree sequentially, one block after another. That takes time. POH creates this verifiable historical record that proves when an event happened relative to other events.
Which allows?
It allows transactions to be processed in parallel across different validators.
Yeah.
They don't have to wait for the whole network to agree on the exact time order for everything because POH provides that order implicitly.
Faster speeds, higher throughput.
Massively higher throughput. And this technical advantage forms the core of the regulatory argument being made to the SEC.
How so?
Well, look at the BZX exchange filing for Fidelity's proposed Solana fund. They argue that SOL, the token, is inherently less susceptible to market manipulation than many other commodities that already have ETPs.
Why? Because the market is just too big and fast.
That's the crux of it. They make three specific claims. One, the SOL market is enormous. We're talking over $90 billion fully diluted market value on average, trading around $2 billion daily across major global platforms.
Okay, size matters. Claim 2.
Trading is geographically diverse and continuous. It's 24/7, 365 across multiple time zones, multiple exchanges.
And claim 3, this sounds like the critical one.
It is. Arbitrageurs, traders who profit from tiny price differences across markets, are constantly eliminating those differences for SOL.
Because it trades everywhere at once.
Exactly. The filing argues this constant, global, hyper-competitive arbitrage makes manipulating the global SOL price prohibitively expensive if you try to pump the price on one exchange.
Arbitrageurs will instantly sell into that pump, bringing the price back down.
Precisely. They buy low elsewhere and sell high on the manipulated venue, correcting the price almost instantly.
Okay, so that's the argument for why it's manipulation resistant. How does that square with the SEC's historical standard, the Winklevoss test?
Ah, yes, the infamous Winklevoss test. Let's simplify that.
Then please do.
The core idea is simple. The SEC fears manipulation. So historically, it required that any ETF must have a surveillance sharing agreement with a regulated market of significant size.
Basically, the SEC needs to be able to spy on the trading activity to catch bad actors.
You got it. If they couldn't watch the market closely, they wouldn't approve the product.
Which sounds like a major hurdle for Solana, given that a lot of its trading happens on, let's say, less regulated global exchanges.
It was a huge hurdle for years. But the SEC effectively created a loophole, or maybe evolved its thinking, when it finally approved the Bitcoin and Ether ETFs.
How?
They accepted the argument that other means of preventing fraud and manipulation could be sufficient. They basically agreed that if the market itself was robust enough, direct surveillance sharing might not be absolutely necessary.
So for Solana, they're leaning on that precedent.
Heavily, because the new CME Solana futures market only launched in March 2025.
Right, not the required 6 months old yet.
Not yet. So the SEC can't yet deem it a regulated market of significant size under the old test. The applicants have to rely on proving the spot market's own massive natural resilience to manipulation through that global arbitrage argument.
Okay, but hang on. This feels potentially shaky. We're saying the price is safe because of global arbitrage across venues like Coinbase, Kraken, Binance. Some regulated, some less so. If the SEC's main job is investor protection and stopping manipulation, how can they confidently trust an aggregated price feed that relies on data from exchanges they don't directly oversee? That feed determines the ETF's value.
That is precisely the point of contention and the remaining regulatory risk. The ETF's integrity hinges on that aggregated price being accurate and reliable.
But the inputs might come from places the SEC can't fully monitor.
Correct. The SEC accepting this market resilience argument for Bitcoin and Ether was a major step. Solana issuers now have to convince them that Solana's market structure is equally robust, relying almost entirely on that $90 billion market cap and massive global liquidity to argue the price is incorruptible at a macro level.
It's a big leap of faith, in a way.
It relies heavily on economic arguments about market efficiency, rather than direct regulatory oversight of all trading venues.
Okay, let's switch gears slightly to the mechanics. How would something like the Fidelity Solana Fund actually work? Security is key here.
Absolutely. So the trust itself would hold SOL tokens plus some cash and cash equivalents for operational needs. The crucial part is custody. All the SOL holdings are kept in secure cold storage.
Meaning offline.
Offline, usually hardware-based, highly secure custody managed by a specialized third-party custodian. This dramatically reduces the hacking and theft risk that individual investors face if they try to self-custody their tokens.
Makes sense. And what about getting shares in and out of the fund, creation and redemption?
Also critical for efficiency. The filings propose that the fund can create or redeem shares using either cash or in-kind transactions. And this technical detail has huge implications.
We definitely need to unpack why in-kind is so much better. The sources really highlight this as a key win for the industry.
It's a massive deal for efficiency and tax treatment. Okay, think about the two ways. With cash creation redemption, if you want to swap your ETF shares for the underlying Solana, the fund manager first has to sell the required amount of SOL on the open market for cash. Then they transfer that cash to you, the redeemer.
That sounds potentially messy.
It is. It creates operational complexity, potential slippage, meaning you might not get the exact net asset value price due to the trading impact, and, critically, it creates a taxable event for the fund itself every time it sells assets.
Which ultimately impacts all the fund's investors.
Right. Now compare that to in-kind creation redemption, which the SEC approved for these crypto ETFs back in August 2025.
How does that work?
It's much cleaner. Instead of selling the crypto, the fund manager simply swaps the actual SOL tokens directly for your ETF shares, or vice versa for creations. An authorized participant delivers SOL and gets ETF shares, or delivers ETF shares and gets SOL.
Ah, so the crypto itself moves, not cash.
Exactly. Because the underlying assets are transferred directly, not sold, it's significantly more tax efficient for the fund and therefore for all the investors holding it.
And it tracks the spot price better?
Much more tightly. It minimizes the spread, reduces slippage. It's the mechanism preferred by institutional players and signals market maturity. Getting that in-kind approval was huge.
Okay, and finally, transparency. How do investors know the price?
Standard ETF practice here. The official net asset value, the NAV, is calculated once daily, usually at 4:50 p.m. Eastern Time, using that Fidelity Solana reference rate index we mentioned, which aggregates trading data from major spot platforms.
But markets move faster than once a day.
Right. So the fund also publishes an intraday indicative value, or I5P. This gets updated roughly every 15 seconds during market hours. It gives investors a real-time estimate of the fund's value based on the current SOL price movements.
Essential for trading. But it still leaves that earlier question hanging, doesn't it?
The surveillance one.
Yeah. If the global SOL price is supposedly resistant to manipulation because of all the diverse trading platforms, how exactly is the SEC ensuring that the specific platforms feeding data into that reference rate index, Coinbase, Kraken, Binance, whoever they are, have adequate internal surveillance?
Right.
Enough to prevent things like front-running or wash trading that could still distort the index price, even if the global price is generally sound. That affects the daily NAV calculation directly.
And that is our knowledge gap question 2. It's the gap between arguing for macro-level market resilience and ensuring micro-level data integrity from the index providers. How does the SEC bridge that gap operationally? We don't fully know yet. So if we zoom back out and connect this to the bigger picture, the direct result of these new generic listing standards is just this flood of applications.
An official regulatory flood.
Yeah. It's resulted in this enormous queue building up at the SEC. As of late September 2025, sources are tracking over 90 active crypto ETF applications.
90, that's way up from earlier in the year.
Massive jump from just 72 back in April.
Okay, 90 applications means we're obviously way beyond just Bitcoin and Ether now. But there's a clear focus on the next wave, right? And October 2025 looks like crunch time.
Absolutely. October is shaping up to be maybe the most critical month for altcoin institutionalization ever. We have this cluster of key deadlines.
Starting with?
Solana, SOL, is setting the pace. The earliest final decision window opens on October 10th, 2025, and VanEck is first in line there.
Okay, and right behind Solana.
XRP. Highly, highly anticipated. Analysts are pegging its approval odds at something like 95%.
95%. That's incredibly high. Why such confidence?
It comes down to legal clarity that most other altcoins just don't have yet. We have to mention the Judge Torres ruling from July 2023.
Right, the Ripple case.
Yeah. A federal judge made a key distinction. While Ripple might have sold XRP as an unregistered security initially to institutional investors, the judge ruled that the token itself, when sold by regular people on exchanges, is not inherently a security.
That's huge. It removes the SEC's main weapon against it.
Exactly. It takes away the argument that the asset is an unregistered investment contract, that legal clarity makes approval seem almost certain. Final deadlines for issuers like Grayscale, Bitwise, 21 shares are all clustering in mid-October.
And the market is ready for it?
Oh yeah. The demand signal is blinking bright red. Rex Osprey launched an XRP ETF using a slightly different, faster process earlier in the year. It had the strongest opening day of all 710 ETFs, launched across all asset classes in 2025.
Wow. Okay, that shows massive institutional appetite. Who's next after XRP?
Next up is Cardano, ADA. Grayscale has a trust conversion deadline on October 26th. If that gets approved, it would be the first U.S. proof-of-stake platform ETF, besides Ether and maybe Solana, bringing another major ecosystem into the fold.
And even Dogecoin, which, relies much more heavily on brand recognition and its huge community than technical utility, perhaps.
It is in the running.
Definitely. Bitwise has a spot DOGE ETF deadline that got pushed to November 12th. And again, Rex Osprey already listed a Dogecoin ETF earlier, and it was the 5th strongest opening of 2025.
So narrative and brand strength clearly matter for attracting investment flows.
Immensely. Beyond those, the pipeline just keeps going. We're seeing filings for Litecoin, LTC, Polkadot DOT, Hedera, HBAR, Chainlink, LINK, Avalanche AVATX.
But some filings are really pushing the envelope, aren't they? Testing the boundaries.
Oh, yeah. Those are the really fascinating ones, the sort of canary in the coal mine filings.
Yeah. You see firms like Canary Capital, aptly named, maybe submitting really niche things, like a staked TRX ETF for the Tron network,
Okay.
and the one grabbing headlines, the PNG ETF. This thing is trying to blend a meme coin, PNG, with NFTs derived from the Pudgy Penguins collection.
Wait, a meme coin and NFTs in one regulated ETF? Seriously, why would anyone file that? Is it just a marketing stunt?
It might look like it, but it's often a deliberate legal or regulatory strategy.
How so?
These really niche boundary-pushing filings are designed to force the SEC to take a clear public stance on complex or novel assets under the new generic standards.
To draw a line in the sand.
Exactly. If the SEC, against all odds, approves it, well, the floodgates are truly open. If, more likely, the SEC issues a formal denial, that denial itself provides valuable regulatory clarity.
Or becomes grounds for a lawsuit.
Or becomes the basis for future litigation challenging the SEC's interpretation or application of the new generic standards. It's a way to strategically probe and map the limits of this new fast-track system.
Okay, so lots of excitement, lots of filings, but we need to remember the lessons from previous launches, right? Bitcoin was huge.
Bitcoin ETF approval in January 2024 definitely fueled that run past $100,000.
Yep.
Created massive expectations.
But then Ethereum.
And the spot Ethereum ETFs launched in July 2024. And honestly, the immediate price action and inflows were underwhelming, kind of disappointing for many.
Yeah.
It taught the market a crucial lesson. ETF approval does not automatically guarantee an immediate explosive price surge. The market might have already priced in the news by the time it happens.
But you're saying the recent altcoin launches feel different?
It seems that way.
Yeah.
Dogecoin rallied before its listing, suggesting anticipation, and XRP saw those huge inflows immediately after its listing. It suggests that for these newer altcoins, getting packaged into an institutional ETF is translating more directly into capital deployment now. Maybe the market learned from the Ether launch. It signals renewed attention and real investment flowing in as we head into this October cluster.
And it's not just the SEC moving things along, is it? Other regulators are involved.
Absolutely. This is becoming a system-wide integration. The CFTC, which regulates commodities and futures, launched a big initiative to allow spot crypto trading on traditional registered futures exchanges.
Okay.
They're also setting up rules to let offshore crypto exchanges legally serve U.S. clients if they register properly as a foreign board of trade.
And the banks.
The FDIC, the bank regulator, removed some constraints, giving banks more freedom to engage in crypto activities, like custody, without needing extensive prior approval for everything.
Making it easier for them to support these ETFs.
Exactly. And finally, there's the pending Clarity Act legislation in Congress. The goal there is to finally draw clear lines about who regulates what, the SEC for securities, the CFTC for commodities when it comes to different types of digital assets. The whole system is slowly but surely aligning to bring this asset class into the mainstream.
Okay, we have covered a ton of ground today, but the main takeaway seems pretty clear. The SEC's rule change, really pushed by legal challenges, has opened the gates. Altcoin ETFs are now on a potential 60 to 75-day fast track. And this has just ignited this intense competition where being operationally ready, getting things like that tax-efficient in-kind creation and redemption sorted out matters just as much now as the regulatory policy itself.
It really feels like the final maturation stage for the crypto market, doesn't it? Let's try our last analogy here.
Okay.
This whole shift from crypto being this obscure, highly technical thing traded in corners of the internet to being packaged in these slick, regulated ETFs. It's like moving from, a very specialized collector keeping rare, fragile stamps hidden away in a shoebox in their attic.
Right. Hard to access, risky to handle.
Exactly. To now storing those same valuable assets in a secure, federally insured bank vault, maybe you represent by a certificate that any regular investor can easily buy and sell in their brokerage account.
It simplifies access, adds that layer of security through regulated custody.
And drives down fees through competition. That's key too.
So for you, the U.S. investor listening, the benefits are real and quantifiable, right? 3 main things.
Yeah, I think 3 big ones. First, Approving these altcoin ETFs drastically cuts down on that premium and discount volatility we saw with older products like the grayscale trusts, which sometimes traded way off from the actual crypto price.
Much tighter tracking to NAV.
Much tighter. Second, it crushes management fees through sheer competition. We saw Fidelity slash its Bitcoin ETF fee to just 0.32% earlier this year just to stay in the game. That benefits investors directly.
And third,
maybe most importantly for many, it provides a regulated, relatively safe alternative to taking on the technical risks and complexities of self-custodying your own tokens. You get professional, regulated cold storage.
okay, so TradFi and altcoins are converging fast.
Yeah.
But as we saw with that Pinju ETF example, some complex, really niche assets are actively pushing the limits of what regulators might allow in these easy-to-access packages.
Which brings us to our final provocative thought and our last knowledge gap question for you.
We talked about these filings, blending meme coins, NFTs, assets that are undeniably highly speculative, maybe even filed partly as legal probes.
Right.
So knowledge gap question 3. If these new generic listing standards do end up approving some of these really complex basket ETFs that include novel assets like NFTs or meme coins, how will you, the investor, tell the difference?
Yeah. How do you differentiate between funds designed for serious, long-term diversification, like arguably the Solana or XRP funds, and those that might be primarily marketing stunts, filed just to test the rules and grab headlines?
It raises a really important question about investor due diligence, doesn't it? Especially when adoption goes mainstream and these things are readily available, you really have to read the fine print.
Absolutely. So as we head into this critical October period, the market's about to find out which of these contenders, the high-speed utility of Solana, the legal clarity of XRP, the sheer brand power of Dogecoin, will ultimately prove they have staying power and really dominate this next phase of institutional crypto adoption.
Keep learning, stay curious, and we'll catch you on the next deep dive.